Obviously, when these guys are in that power, much like Chief Justice Gorsuch at the State of the Union, they have to look stern, middle of the road. They're not going to be influenced by politics. But anyway, I get a kick out of that. But again, I'm easily amused. We have Charles Payne with us. We have Moody's chief economist, John Lonski. Gentlemen, welcome to both of you. Does the world change for him now? Does it mean that he is, in recognition of this backup in rates, going to have to acknowledge the obvious? The economy is picking up steam. He might have to hike more than the 2 times, even 3 times the market had forecast.
Well, the economy's in much better shape today compared to when Janet Yellen took over. There's no question about that. But, you know, oddly enough, this latest upturn by Treasury bond yields may be doing the work of future rate hikes. Look at housing sector share prices. They're getting clobbered. The overall market's down by more than 4%. Housing sector share prices down by 7.5%.
You don't want too widening a gap between short and long-term rates. Short-term rates the Fed controls. The longer-term ones it doesn't.
Well, it has more control nowadays because of its planned reduction in holdings of Treasury bonds. And if we have too steep of a jump by the 10-year Treasury yield, begins to hurt housing activity, the Fed might decide to downsize its planned reduction of Treasury bonds.
What do you think?
I would think that the Street have to already have 3 rate hikes built in. At least, I mean, you consider coming into Friday that the Atlanta Fed had gone to 5.4% on the first quarter GDP. We'll get the fourth quarter, which, by the way, even though it wasn't 3%, all the domestic stuff in that fourth quarter GDP was absolutely phenomenal.
By the way,
it was only
might
trade.
Be revised up.
It could be revised up, but trade was what held us back.
Right.
And I'm looking at earnings and lost in all the haze of the news last week. 50% of companies have reported fourth quarter. 80% have beat on the top line, 75% on the bottom line. Guidance is very strong. So I would suspect that most people have modeled in at least 3 rate hikes for the year, which is not bad if it's justified by a growing economy.
Is this stock sell-off justified to you, John?
It makes sense from the perspective of we don't know where rates are going to top off. We don't know where bond yields are going to top off. So right now, I'd be very cautious with equities. I'd avoid this market.
So someone who's looking at a sell-off of this magnitude right now and realizing it's been over 1,000 points from our highs, we're well over 5% from our highs, you're saying it might not be done.
It may not be done. I could see the market perhaps dropping by another 7%. And if the market drops by another 7 or 8%, then I believe we'll get some sort of remedial response from the Federal Reserve, especially as far as their holdings of bonds are concerned, not so much the Fed funds rate.
What do you tell clients, particularly because you appeal to a lot of young clients as well? No sooner they've been drawn into these markets because they were late coming in than kaplooey.
Well, I have to admit, most of my clients are already in it.
Is that right? Right.
I was in the market when Obama was president, and I was fairly bullish. So over the last few weeks, the internals have been getting sort of weak. I always talk about market breadth, advances versus decliners, new highs versus new lows.
But when they fall like this, is the argument you always make, well, when it's down, you're buying more shares of the dollar cost average.
I'm salivating. I don't think we'll go down to never 7%. But consider the idea that, Friday we were down. It was the 5th or 6th worst market drubbing in the history of the Dow, off 2.5%. All the other ones before that, though, were 7, 8%. I just happen to believe that if you're investing in great companies that are driving top and bottom line and they pull back like this, you want to own them.
Here's my best analogy for the current situation. 1987, a new Fed chairman, Alan Greenspan, had just taken over. He got a little bit aggressive with rate hikes. The 10-year yield was at 7% January of 1987. By October 19th, it's above 10%. And by the way, the morning of October 19th, the great stock crash, that was the last time the 10-year yield was at 10%
That's
or higher.
Right. And by the way, we had a big sell-off the Friday before.
Yeah, right. We have a sell-off the Friday before, but that was, and then the bond market.
Are we setting up for something like that? At point terms, it's different in percentage.
Strong earnings. We had very strong earnings growth in '87. The economy was going gangbusters. Everything was on full throttle.
Could this mirror that? Now, I should stress that even with the 1,000+ points we've seen, it represents about 5%.
That was
one day on the 19th. It was a quarter of the Dow's value.
You're not going to see the market fall by 25% or 20% again at any point in the near future. I don't think that's going to happen. But I think it's premature to state confidently that we're nearing the end of this current sell-off, especially if bond yields continue to rise. 10-year Treasury yield was expected to average 2.6% in the first quarter of this year. Now it's at, what, 2.85?
You just said, though, in 87, right, the yield was a 9-10%. Why would a 3% yield wreck an amazing stock market with an amazing economy that's
This is
just
what you're
coming out of
used
the
to.
doldrums?
What if you're just used to 1.25 at its lows, 1.5,
You know,
2%?
And then people are going to get nervous. Look at on the housing side, what's happening there. Housing share prices are getting pummeled.
That's okay. That's one thing. Separate the share prices from what's happening. Construction spending in December was a record, driven by residential spending.
So you're not panicked.
I'm not panicked, and I really am concerned about people.
If I came up to you and said, I want to buy at these levels because I think we've hit lows, you would
I'm
tell
saying that I'm going to be an aggressive buyer this week for sure.
Wow.
Yeah.
And what would you?
I don't know where the bottom is, though.
I'm just going to hold. I'm not going to get.
Well, I'm holding a lot,
yeah,
but I had taken some profits into this week, in part because you could see some that it was getting a little wobbly beneath the surface.
All right.
Add one more thing. The VIX index, I think the last time I looked, is it at 18 or higher? Right now, the
That's a
junk bond
gauge of volatility, fear.
Yeah. And now what's important about that index is highly correlated with corporate bond spreads, what corporations have to pay for borrowed money. The junk bond yield spread recently is about 330 basis points. When you get the VIX index 17 or 18, the junk bond spread goes all the way up to over 500 basis points.
So what does that mean? That
That's not
tells
going to be
you
good for
that.
capital formation. It may not be good for credit quality.
But it could also be an aberrant event.
Yeah, it could be. That's right.
Okay.
And it could be that these.
So, I mean, ultimately, we knew that rates had to go. They weren't going to stay at zero forever. So, I mean, it's one of these things that if 3% is enough to crash the market, then we're all in a lot of trouble because the economy is really phenomenal
Or they
right
could
now.
be using this as an excuse to sell.
Well, I just had our show meeting, and I was just saying, ultimately, sometimes it's one of the problems sometimes with financial TV is we always have to have an immediate reason,
right.
And sometimes it's more sellers than buyers. And after this run, a lot of people cashing in the chips, but I think smart folks are going to be buying pretty soon.
At the show meeting, what was the mood?
Downtrodden. We had one New England fan, and then everybody else just hung over.
Is that? That sounds like your staff. All right, Charles, thank you very, very much. Again, we're following this very, very closely. John Lonsky, thank you. Want to give you a fair and balanced view on that. The bullish, slightly less bullish view on all of that.